Hello, my name is Brenton Harrison, and we're here today to cover a particular type of investment called index funds. Let's get started. So last week I was going through the library of content that we've posted over the last couple of years, be it on our blog, this YouTube channel, other places where we've done guest posts, and I realized that we've covered a lot as it pertains to different types of investments. We've covered stocks, we've covered bonds, we've covered mutual funds, we've even covered exchange traded funds, but there's one really type of popular investment that we haven't covered on any of these platforms, and that is index funds. So I wanted to make up for lost time and cover what this tool is, why it's so popular, and how you can know whether or not it's the right fit for your portfolio. An index, or a market index, is a collection of companies that represent a specific segment of the market. Now, there are indices of varying popularity. Some are really well known, some are more obscure, and you can have ones that track companies of a certain size on the US stock market. You could find an index that tracks portions of the bond market or the entire bond market. There are even indices that track certain companies in certain foreign countries. No matter what you think of, there's probably an index that tracks the movement of companies that fall under that umbrella. Now, that's an index itself, but an index fund is a mutual fund or an exchange traded fund that's set up so that it mimics the performance or tracks the performance of the companies that comprise that index. Rather than paying a team of people to make investment decisions on your behalf, when you have an index fund, all you're doing is setting yourself up to track the performance of the underlying market index. This type of investment is a form of passive investing, and many consumers like them because of their simplicity, but also because of their low fees. Since you're not paying for as much human oversight, the fees that you see associated with an index mutual fund or an index ETF are typically lower than that you'd find with an actively managed fund. And since many of these indices have performance metrics that you have to hit for a company to be included, be it a price of a share of their stock or the amount of cash they have on hand, when you're tracking that underlying index, you can do so with the comfort of knowing that your return is going to mirror the highest performers in that segment of the market. This characteristic prevents you from having to be the one to know when to buy or sell certain companies. The index has certain rules, and they're the ones who decide which companies come and which companies go. Now, if you follow any of our other content, you're well aware that there are people out there who speak in absolutes, and I hate when people speak in absolutes when it comes to finances. So you do see people say that index investing is the only way that you should invest. Well, I'm a big fan of index investing, but I won't go that far. But what I do want to do is give you some more context as to how these funds are structured, some examples, and how to know whether it is or is not the right thing for your portfolio. While the S&P 500 is probably the most popular and well-known index, and you've likely heard of it, it does only track one portion of the market. See, the S&P 500 follows the performance of 500 large publicly traded U.S. companies, but there are indices out there that either track larger portions of the market or just different portions than what you find in the S&P 500. You have the Dow Jones, which covers the returns of 30 large cap blue chip stocks, and we'll cover what that means in a second. You have the Bloomberg U.S. Aggregate Bond Index, and that tracks the performance of the entire bond market. You have the MSCI EAFE Fund, and that follows international stocks from specifically Asia, Australia, and Europe. You have the NASDAQ, which covers 3,000 plus stocks, real estate investment trust, American depository receipts. It's not just stocks, and the NASDAQ covers a wide range of different investments. And then you have the Wilshire 5000. And even though it's 5,000, which was probably the amount of stocks it had when this index was comprised, this index actually tracks the performance of over 7,500 U.S. stocks. So compared to the S&P 500, it follows a much wider range of the market than what you find in that popular index. Choosing which of these is the right fit for you all boils down to deciding what portions of the market to which you'd like exposure. If you're looking to have international exposure in your portfolio, you shouldn't be investing in the S&P 500 because that only mirrors the returns of those 500 large publicly traded U.S. companies. Conversely, if you're trying to get some exposure to things like bonds, you shouldn't be investing in an index that only tracks the performance of stocks, period. You would have to have exposure to an index that tracks this segment of the market. You also want to know how these indices are weighted, and here's the best way I can describe this. If you have $500 and you put it into the S&P 500, they don't simply take that $500 and divide it by 500 and put $1 with each company in that index. That's not how these indices work. Instead, they're going to have certain metrics that they use to determine which companies in that index should be weighted more heavily. Meaning, going back to our example, instead of you putting $500 in the S&P 500 and having $1 go to each of the 500 companies, the index would see that these particular companies over here should have a bigger impact on the comings and going of the index. So if you put your $500 in this index, you could see more than $1 go to these companies and less than $1 go to those with a lesser weighting. The two most common ways that an index is going to weight its holdings is either by market capitalization or price per share. Price simply refers to the cost of one share of a company's common stock. So if you have a price-weighted index, they're going to take all of the companies that comprise that segment, and the ones with a higher price per share are going to be weighted more heavily than those that have a lower price per share. Conversely, market capitalization is not just about the price per share. It's also about the number of shares that that company has outstanding. It's a measure of how much cash they have as a company, which also helps determine its size. Now, this metric has a term. And the term, where when you take the price per share and you multiply it by the number of shares that company has outstanding, is called its market cap. So if I take a company and that company has a price per share of $20 and they have 1 billion shares of stock outstanding, they have a market cap of $20 billion. So now you understand that this tool is a way to measure how large these companies are, and there are different categories based on the market cap that a company has. Large cap companies are those with a market cap of $10 billion or more. Mid-cap companies are those with a market capitalization between $2 billion and $10 billion, and small-cap companies are those with a market cap of less than $2 billion. Since having a lot of cash typically implies that a company is pretty well established, when you're a large-cap company and you have a lot of cash on hand, you're typically seen as a more stable place, a quote-unquote safer place for an investor to park their cash. Thus, an index that is weighted by market capitalization is one that puts more weighting towards the companies that have more cash on hand as compared to the others that comprise the index. Now that you understand the terminology, let's look at those same indices to see how they're weighted, either market cap weighted or price weighted. The S&P 500 is market cap weighted. The Dow Jones, that has the 30 large cap blue chip stocks, is price weighted. So now you know what it means when we say large cap. And blue chip just means that it is seen as a stable type of company. It's seen as somewhat of an institution in its space. Apple might be a blue chip company. They are firmly established. They are seen as an institution in the tech space. That would be an example of a blue chip stock. But the Dow Jones, which covers a much smaller number of companies, comprises large cap blue chip stocks, but it is not market cap weighted. It is price per share weighted. The Bloomberg Bond Index is market cap weighted, as are all of the other popular indices that we covered in our example. Now, adding the knowledge of how an index is weighted to what you already know about these companies can be really helpful, because since the S&P 500 primarily focuses on a company's size when it comes to cash, an investor looking for exposure to a smaller company with growth potential could look to like a broader index or even one that is price weighted, because the price weighted doesn't necessarily mean that they have to have a large market cap as well. But conversely, an investor who wants to ensure that their portfolio has those large, stable companies, they might avoid something like the Dow Jones because market cap isn't a factor in how it's weighted. You can absolutely combine different indices in your portfolio when you're trying to find the right blend for you. You don't just have to say, oh, I'm an S&P 500 guy, or I am an aggregate bond index girl. You can decide, hey, I want a little bit of this, a little bit of that. And as a matter of fact, there's a particular type of investment that gives you an idea of how this can work, and it's called a fund of funds. A fund of funds is a pooled investment where when you look from that 10,000 foot view, you'll see that what they've done is they've put together, multiple different mutual funds or ETFs or index funds so that you have at the end, for lack of a better term, a larger kind of super portfolio. And you can have a fund of funds that could have 4 or 5 different other funds in it with all different varying allocations in terms of percentages so that you can have the right blend as it pertains to the risk you want to take in that particular investment. Let's look at an example. Here we have a fund that comprises 4 other index funds. 20% is invested into the MSCI EAFI index fund, giving our investors some international exposure. You have the S&P 500 fund representing 40% of its holdings, which gives our investor access to some of the largest and hopefully stable companies in the U.S. stock market. And 20% each is in funds that track the Dow Jones, which are those blue chip stocks we discussed with the high share prices, and the Bloomberg Aggregate Bond Index. You can see that there are 4 indices that are represented, but this fund is essentially 80% stocks and 20% bonds, so it's pretty aggressive. And an aggressive investor who wants to keep their costs low, but also kind of have access to a broader swath of the market, they might consider this fund of funds rather than trying to figure out how much of each index to invest in on their own. This might sound like an odd thing to hear from an investment advisor, but in the long run, I do feel that an index is going to outperform a human manager who's trying to track the performance of those same companies on their own and making decisions on when to buy and sell. If you had $100,000 and you put half of that money in an index for 50 years and it's tracking a particular portion of the market, and you gave the other half to a human manager who's tracking a similar segment of the market for those same 50 years, but they have to make the buy and sell decisions, in the long run, I feel that more often than not, that index is going to beat that manager. In fact, in 2007, Warren Buffett placed, I think, $1 million bet that over a long period of time, an index would outperform an active manager, and he won that bet. Like, it wasn't that close when it came down to it. And if your only objective is to take a really long period of time and say, at the start, I have this much money, I want to find the tool that gives me the most money at the end of this period, an index fund might be the right thing for you. As a matter of fact, we talked about it. The fees are typically low. It's pretty simplistic. You don't have to go in and really track the thing as long as you're comfortable and confident in that portion of the market. So it can be a really hands-off way of investing. But not everybody feels that that's everything that's involved in the decision. What is it at the beginning and what is it at the end? For some people, it's very much important what happens in that in-between period. Why? Well, they might need access to some of that money within that period of time. They may not be able to wait 50 years before they access that account. Maybe they want to retire early. Maybe they've decided they want to help their kids with schooling. Maybe they need some of that money for a down payment. And there are other investors who, even though after 50 years they might have a higher return with that index, they may not have the investment risk tolerance where they can stomach some of the volatility that can come by investing in certain indices. There are even investors who pick their investments not based on just the performance of the share price, but in terms of how the companies reward their shareholders. What I'm referring to are dividends. A dividend is when a company has excess profits and they choose to share that profit with their shareholders by issuing a dividend. So you have some who give them annually. You have some who never give them. You have some who give them as frequently as quarterly. So some investors pick their stocks specifically by companies who have consistent dividends that they give to their shareholders. And they use those dividends to live off of or to bolster their income, to prepare for an early retirement, to give themselves consistent income in retirement. And their only concern is not just what was the share price at point A versus point B. It very much matters to them what happens in that in-between period. Even when you look at your time horizon, which is the amount of time that you plan to have this money invested before you need it, you could find that a certain index that you might enjoy over a longer period of time is not a fit in the shorter period. Maybe you want to buy a car in 3 years, or you're investing money that you plan to use for a down payment in 5 years. Well, if that's the case, investing in an index that has really great long-term returns, but also a lot of short-term volatility may not be appropriate for this particular portion of your portfolio. The point when you're picking any investment is not just the return, it's the return. It's the volatility, it's your risk tolerance, it's your time horizon, and it's making sure you understand in which you're invested. So when people say that you should only invest this way, active, passive, index, ETF, mutual fund, managed account, let it ride, it's not that simple. Nothing in your life happens in a vacuum. Everything that you do in one area of your finances impacts another area of your finances, and you have to put all that knowledge together to use it to make the right decision for you. I hope you found this video informative and educational so you can learn a little bit more about this piece of investing knowledge that we somehow had left off of our plate when it came to our content in the past, but I'm definitely glad that we covered index funds now. Once again, my name is Brenton Harrison. If you haven't already, please subscribe to our channel and subscribe to the notifications so you know when new content is posted, and we'll keep bringing you that content as frequently as we can. See you soon.